Want to profit from a basic need that people can't live without? Interested in getting a juicy, market-smashing yield from a Dividend Aristocrat? Does getting a high-quality dividend growth stock on sale sound good to you? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a real estate investment trust providing housing. There are certain things we can't live without. Air, food, water, all come to mind pretty quickly. But what about shelter? I'd say it's right up there with the rest of them. Well, this company provides shelter, and it does so in unique markets with built-in advantages. That's why this REIT continues to grow its revenue, profit, and dividend like clockwork. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Essex Property Trust Inc., which appear to be trading at a significant discount today. Essex Property Trust Inc., stock ticker ESS, is a real estate investment trust that owns and operates a portfolio of U.S. West Coast multifamily properties. Founded in 1971, the company is now a $14 billion by market cap real estate giant that employs more than 1,700 people. Essex Property Trust focuses on 3 different supply-constrained markets: Southern California, 42% of net operating income, Northern California, 40%, and Seattle, 18%. The company's property portfolio consists of approximately 62,000 apartment homes across 252 apartment communities. Many forms of commercial real estate are rather discretionary in nature, think shopping centers for example. However, Essex Property Trust focuses completely on shelter, a non-discretionary basic need. Everlasting demand is built right in. Outside of malfeasance, it's pretty difficult for Essex Property Trust to go out of business. There's almost no risk of obsolescence as shelter is timeless. Technology is powerful, but it's hard to imagine it changing shelter. People will always need somewhere to live. All that said, the company's concentration on the US West Coast could be both the company's greatest strength and greatest weakness. On one hand, a combination of unique geography and heavy-handed regulation conspire to limit supply. This is a big advantage. Existing supply is that much more valuable when it's so difficult to bring new supply to market. These same issues plague single-family houses in these markets, which only serves to make apartments more affordable by comparison. Moreover, because of an intoxicating mixture of high-paying jobs, comfortable climates, and beautiful nature, the West Coast is highly desirable. On the other hand, very high costs, a homelessness crisis, and rising crime along the I-5 corridor all collude to temper demand. In addition, the work-from-home trend, which has shown staying power, makes it easier for some workers to move to cheaper locations inland without losing their high-paying jobs. But not all jobs are remote, and climate isn't mobile. Many of the problems facing the West Coast are fixable and most likely temporary, but the appeal of the West Coast is not temporary, nor is the need for shelter. And that's why Essex Property Trust should continue to grow its revenue, profit, and dividend in a fairly perpetual manner over the coming decades. To date, the company has increased its dividend for 29 consecutive years. That stretches all the way back to the company's original IPO, showing just how consistent and determined Essex Property Trust has been since the start. There are only 3 Dividend Aristocrats that are REITs. Essex Property Trust is one of them. The 10-year dividend growth rate is 7.2%. That's actually fairly high for a REIT, as REITs tend to be slow growth income vehicles. Notably though, there has been some mild deceleration in dividend growth over the last few years, but it's not a massive divergence and it's still quite healthy growth for a REIT. Furthermore, while the dividend growth has come down just a bit, the yield has risen in kind. The stock's 4.4% yield blows away what the broader market offers. It's also 130 basis points higher than its own 5-year average. Smartly, the market has already adjusted for the lower growth rate, compensating new investors with a higher yield. And this high yield is protected by a payout ratio of 62.5%, which is relatively modest for a REIT. For income-oriented dividend growth investors, Essex Property Trust offers a compelling yield backed by a great legacy of reliable growth. Looking at business growth, Essex Property Trust advanced its revenue from $611 million in fiscal year 2013 to $1.6 billion in fiscal year 2022. That's a compound annual growth rate of 11.3%. This is really good top-line growth, but it's important to remember that a REIT typically funds growth by issuing equity and debt. That's why it's especially important to look at profit growth on a per-share basis when dealing with a REIT. It moves past absolute growth and drills down into the more insightful relative growth. Moreover, instead of looking at earnings, you want to look at funds from operations. Funds from operations is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back into earnings. The company grew its funds from operations per share from $7.59 to $13.70 over this period, which is a compound annual growth rate of 6.8%. This is the more accurate representation of the company's true growth profile. It's obviously not as good as the top line growth was, but it's still quite good. We can also see a tight relationship between funds from operations per share growth and growth of the dividend over the last decade. That shows excellent control from management. Looking forward, CFRA currently has no 3-year growth projection for the REIT's funds from operations per share. That's unfortunate. I generally like to compare the proven past up against a future forecast, which helps with extrapolating out results. Since this is absent, I'll instead shift over to the most recent guidance provided right from Essex Property Trust itself. Per the company's Q1 report, released in April, guidance calls for $14.74 to $15.12 in funds from operations per share for this fiscal year 2023. That's $14.93 at the midpoint. What's especially noteworthy here is that this was a guidance raise from Essex Property Trust. The new midpoint is an 18-cent improvement over the previous midpoint. Impressively, this would represent 9% year-over-year growth in funds from operations per share. That's actually an acceleration in growth compared to the prior decade's trend. I think this illustrates a great case of narrative versus reality. There's a popular narrative that California, the major market for Essex Property Trust, is somehow quote-unquote dying, yet Essex Property Trust is growing faster than usual. Here's the reality. If California were a sovereign nation, it would rank as the world's 5th largest economy in terms of nominal GDP. California is by far the most populated, i.e. popular, state in the USA. Yogi Berra would have probably put it something like this: California is too crowded. Nobody goes there anymore. Yes, California did recently lose a minor percentage of its population recently, but its overall population is up significantly over the last decade. I see nothing to indicate that Essex Property Trust can't grow over the next decade at least as fast as it did over the last decade. And that's coming off of a base where scheduled rents are higher than ever. Putting it all together, I see Essex Property Trust more or less doing what they've been doing, growing the business and dividend at a mid-single-digit annual rate or better. Meantime, you're getting a near 4.5% yield to start off with. That's a clear path to a 10% annual rate of total return over the long run, and it could be achieved on a low-risk basic need. I think that's pretty appealing. Keep in mind, through January 31st, 2023, Essex Property Trust has provided a 4,102% total return since its June 1994 IPO, far ahead of the 1,445% provided by the S&P 500 over the same time frame. Moving over to the balance sheet, Essex Property Trust has a solid financial position. Essex Property Trust has $12.4 billion in total assets against $6.5 billion in total liabilities. The company's investment-grade credit ratings are as follows: BBB+ Fitch, Baa1 Moody's, and BBB+ Standard & Poor's. Essex Property Trust has been a fantastic investment for nearly 30 years. I don't see why the next 30 years won't also be fantastic. And with economies of scale, luxury properties, regulatory know-how in difficult markets, and an entrenched footprint in supply-constrained and desirable locations, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. California's infamous red tape is a double-edged sword. Constraints on bringing new inventory to market assist existing properties, but it's also difficult to grow the portfolio. Real estate is generally cyclical, although the basic need of shelter does mitigate some of that cyclicality. Essex Property Trust has indirect exposure to the technology industry, as a lot of technology companies are based on the West Coast. The capital structure of a REIT relies on external funding for growth, and rising interest rates can create harm in two ways. Debt becomes more expensive when rates are higher, and competitive yields elsewhere reduces demand for the equity. Essex Property Trust lacks geographic diversification. The West Coast exposure introduces risks of natural disasters such as earthquakes. As work becomes more flexible, more remote workers could choose to leave the West Coast for cheaper locations inland. I think these risks are definitely worth considering, but the quality of the business can't be forgotten or denied. Also worth considering and not forgetting is the valuation of the business, which looks very appealing after a 30% slide in the stock's price from its 52-week high. The price to funds from operations ratio is 14.3. That's decently analogous to a PE ratio on a normal stock, and it depicts a very undemanding multiple. It's not far off from the price to cash flow ratio, which is 14.6. For perspective on just how undemanding this is, the stock's own 5-year average price to cash flow ratio is 20.6, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. That growth rate is on the lower end of the spectrum I'm usually looking at. I find it appropriate to be cautious when extrapolating out growth for REITs, largely due to the fact that these are income vehicles that rely on external funding. However, let's be clear, this number is well below what Essex Property Trust has delivered over the last decade in terms of both bottom line and dividend growth. In addition, current guidance is calling for year-over-year funds from operations per share growth that's higher than this number. Overall, I think it's a very reasonable, if cautious, assumption of the long-term dividend growth path for Essex Property Trust. The dividend discount model analysis gives me a fair value of $281.16. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes in dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ESS is a 5-star stock with a fair value estimate of $317. CFRA rates ESS as a 2-star sell with a 12-month target price of $214. An interesting range, which is made to be even more interesting when you see that CFRA was much more sanguine on the stock back in 2022 when it was in the 300s. Averaging the three numbers out gives us a final valuation of $270.72, which would indicate the stock is possibly 22% undervalued. Here's the bottom line, guys. Essex Property Trust Inc. is a high-quality REIT providing a basic need for people and profiting handsomely from it. With a market-smashing yield, a moderate payout ratio, a healthy dividend growth rate, nearly 30 consecutive years of dividend increases, and the potential that shares are 22% undervalued, long-term dividend growth investors would be wise to consider buying this Dividend Aristocrat after its massive drop in price. And now for a special news announcement. Cisco Systems Inc., stock ticker CSCO, just came out with a strong Q3 report, beating on both the top line and bottom line. The company also boosted guidance. Gotta love it. We last analyzed and valued Cisco late last year, estimating fair value for the business at right about $56 per share. This report only reinforces my enthusiasm for it. Don't underestimate Cisco. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, And I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.